So George, yeah, great, thank you.
Okay.
Sorry to disturb you.
No, that's fine. So yeah, again, so it's a great honor to have Professor Basu here. So currently, Professor Basu is in Philadelphia, the Professor of Accounting and Robert Livingston Johnson Senior Research Fellow and Associate Dean for Research and Doctoral Programs. A little bit of background, Professor Basu earned his PhD and MS at the University of Rochester and MBA at the Indian Institute of Management, Calcutta. And as I mentioned, a lot of the research is based on the conservatism, but you have asymmetry earnings management, a variety of areas, and Professor Basu has published widely in top accounting and finance journals. And interestingly, Professor Basu has earned the AAA's 2019 UG Agiri Memorial Lecture on the Foundations of Accounting and Best Paper Award in 2006 and 10. So we are going to be talking in the next hour about the accounting and finance effect of changes in bank competition. And I will be monitoring the chat. So if you do have any questions or would like to intersect with a discussion, Professor Basu will be happy to take that throughout the hour. So I will stop the share. Thank you again so much for being here from Philadelphia. And over to you.
Let me first share my screen.
Yeah, sorry that you have to do this again.
Okay. So, okay. So it's difficult sort of toggling between screens, but hopefully I'll make it. Thank you for inviting me, Salma and Monomita and the rest of the BAFA SEAG group. It's a pleasure to join you, and thank you to Nerissa for coming in early and cheering me on from the US. Because it's an accounting and finance and even banking audience, I thought I'd try to pull together a couple of papers that I'm working on bank competition. One paper is on bank competition and borrower conservatism. It's co-authored with Yi Liang, who's in the accounting department with me, and Leah Howe at a UT Dallas graduate who had independently written a similar paper, and we sort of merged the two papers. And the other paper is on bank competition and firms risk-taking. So this is a paper with two finance colleagues who used to be at Temple, but have now moved on to bigger and better things, so Hussein Maliki and Masa Kaviani. So I'm going to talk about both of these papers together, but a little bit of the conservatism paper more earlier and the banking paper later. But broadly speaking, what we're doing here is looking at how bank competition affects borrowers' risk-taking, that's the finance paper, and the conditional conservatism, which is the accounting paper. The main insight we have is that the threat of new bank entry, which is a different form of competition than we normally think about. So normally when we think about competition, we don't think about competition between the firms in the industry or the banks in the industry. If you think about Porter's 5 forces framework, there's a sort of competition within the industry, then there's sort of bargaining power with customers and suppliers, and then there's the threat of new entrants and so on. So here we're going to be looking at an event which has new entrants, and we're going to sort of look at how that affects our analysis. So the threat of new banks in this particular situation we're going to be examining threatens incumbent banks' power because the incumbents are now going to have more competition. And in particular, if they had bargaining power with borrowers, that's going to be reduced now that you have these new firms that could try to compete with them. To the extent that they had bargaining power, they could have charged higher interest rates and could have forced the lenders or borrowers to report conservatively. We'll see why that matters. But if there is now this threat that the competition will not require the same things, then the incumbents are going to be forced to reduce this because of competition. So the related prior research mainly looks at what happens to the banks, the incumbent banks, when this particular event happened. So the idea would be that did the banks increase risk taking or reduce risk taking? Did the banks report more conservatively or less conservatively? And then they draw inferences about what happened in the economy, assuming that whatever's happening with the clients is getting passed through to the banks. So they use different diff tests, and we're going to sort of show that there's a small problem with what they did, which gets them to different inferences than we did. Okay, so why banks, first of all? So we're going to be studying US public firms because in the US, at least, we don't have access to as much good private firm data as you have in the UK and Europe. But it turns out that banks lend a lot of money to public firms in the US. So if we go back to, say, 1994, the black line is the share of bank debt and the total debt on firms' balance sheets. And you can see that it starts at around 30%, and by 2015, 2016, it's more at 55 to 60%. Obviously, the red line, which is the converse of that, the remaining debt, drops over time. And the sort of crossover point is around 2007, 2008, where it's about 50% each. Now, the black line itself is composed of two types of financing. The green line, which is lines of credit, and the blue line, which is regular bank loans. Okay, and both of them have sort of gone up over time. There's some events that you can see in the data. So you think about SOX, we know that that's going to have, because of litigation risk and so on, that's going to affect public securities, such as bonds. We already know from the equity market, but it also affects public debt. If you think about the global financial crisis and the Dodd-Frank Act, that's again going to sort of reduce this public debt. But the biggest change happens right at the beginning of this period, which is the event we're going to be looking at, the Interstate Bank Branching and Enforcement Act. So as way of background, you need to know that the US system is very different from most countries because the US started off as many different states with each their own governments and each their own regulations and policies. So banks, before the US became independent, each state provided charters to the banks, or even cities would provide charters. And so every bank had a different set of regulations it was operating under. Once independence is gained, they try to create a national bank, but Andrew Jackson basically stopped that from happening. And so then the states got back into the game, but they restricted the number of branches. The idea was that each town would sort of develop banks because the cities and towns themselves are built around religious denominations. So each religious denomination wanted their own churches, their own banks, and so on and so forth to serve their adherents. So in 1863 and 64, the US passed these national bank acts to try to create national banks again, but left this branching and geographical expansion to the state regulators. And so the states basically said, we're not going to let anyone come into our states, we're going to protect our home turf. So some sort of regulatory capture. Glass-Steagall separated investment and commercial banking. This was a topic in the previous session with Rainey Stock. And then during the Great Depression, 4,000 US banks failed. But right over the border in the north, not a single bank failed in Canada. And that's because they did not have the Glass-Steagall Act or these other state branching restrictions. So they were pretty diversified and none of them failed. But in the US, by regulation, each bank was limited geographically and by function. So they had very little diversification, and so a lot of them failed. Once Friedman and Schwartz and others in the 60s started pointing out these historical things and sort of pointing out that this probably inefficient regulation, then between 1970 and 94, lots of deregulation happened in small steps. The big bang was this Interstate Banking and Branching Efficiency Act, which was passed in 1994 and allowed states to adopt the provisions over a 4-year period. So the main thing here was that IBBA allowed banks to enter new states, either by buying existing banks or by buying branches of existing banks or by opening new branches themselves. And so this was the first time that the US allowed geographical diversification on a large scale. So all the US states adopted the IBBA between 94 and 97 in a first wave, and there's a second wave a little bit later, but much smaller, with different openness provisions. So there are 4 main ways that banks, the states could restrict entry. So one was a minimum age for the bank to be acquired. So you couldn't acquire new banks. A second was whether you could start new branches yourself or whether you had to take over existing branches or existing banks. Third was whether you were allowed to acquire a single branch or you had to acquire the whole bank to get branches. And then fourth was a cap on the amount of, or the percentage of deposits that outside banks, out-of-state banks could raise. Okay. And so what happened as a consequence is that the number of in-state branches, so the incumbent banks, those are the ones in blue, declined. So if you look at the total number of branches in the US in 94, there were about 58,000 or so. They started declining, and the number of entrant branches, those are the ones in gray, started increasing. You can see that it keeps going up over time, and the blue ones keep going down over time. Part of it is that the gray banks basically acquired blue banks. So obviously those then get converted into out-of-state branches because they're now owned by an out-of-state bank. And the other is that the gray banks started their own branches. So there's 2 parts to that. But overall, you can see that by 2010, sort of the out-of-state banks had about 40% of all the branches across the states. If you look at the bank size, the incumbent banks tended to be smaller, the entrants tended to be larger. So the entrants were the Citibanks, the Bank of America, the Chase, JP Morgan Chase, and so on. And so Wells Fargo. So these were the banks that expanded, and because they were grabbing market share, the smaller banks either failed or were taken over. So on the black bars are the small banks in hundreds. So it's say 280 banks per state in 1990, I guess that's 1987. And the blue banks are in units. So there's, by the end of the period, 2016 here, there was about 4 large banks operating in a state on average. So these are mainly the external banks, out-of-state banks. And so you can see this in what's going on with the banks. The green arrow there was when IBBA sort of finally took hold. So 97, that's when you start seeing those big banks entering. And if you look at what happened to the deposits, well, starting in 97, you can see that the small banks basically started losing deposits to the large banks. So those are the entrants, and they're eating away at the deposits that small banks had. And so the small banks are losing bargaining power. Before, they were the only game in town. Now, at least in the bigger cities, you have these large banks coming in and taking market share. So what do we find? In the accounting paper, we find that conservatism decreased after IBBA. That is, as the small banks lost bargaining power, they were less able to enforce or demand conservatism from their lenders, from their borrowers. And this conservatism decreased more in states that had more large banks entering. Now, the large banks normally you'd expect would have greater bargaining power, so they should be the ones demanding more conservatism. But what they were doing was using other grabbing market share by having access to a bigger pool of finance. So they were able to charge lower interest rates. And they'd also invested in better monitoring technology. So they had more elaborate credit scoring models and so on. And so they were able to monitor the borrowers using other techniques that the small banks didn't have access to. We find that this decrease in conservatism was greater when incumbent banks were weak, so they were smaller, when the local firms relied more on bank loans as opposed to public financing, and the firms had fewer other monitors, such as large block holders or financial analysts tracking them. And the idea is that these parties also demand conservatism, so just because one monitor doesn't need it, doesn't mean that the others don't. And finally, the contracts also began containing less governance after IBBA. So the small banks were forced effectively to reduce the number of governance by the large banks coming in and requiring less governance. So to compete, they were forced to have less governance. And I'll show you these as you go through the paper. On the finance paper, what we find is that the firms that were borrowing from these banks became less risky as measured by earnings volatility or EBITDA volatility, and a host of other measures, which we'll talk about later. And again, this happened more in states that opened more to entrants. The way that they reduced risk was by investing more in CapEx and this approximately the same amount in R&D. So they didn't cut R&D, but the R&D became less risky. And so overall, there's a sort of shift in the portfolio of investments. And the idea is that as they were offered lower interest rates, they could afford to take on projects that were previously negative NPV became positive NPV. So less risky projects now became feasible. And so they were taking on this mix of new projects with more stable cash flows, but that were less risky, but then wouldn't earn enough to pay the interest. And again, the decrease in this risk-taking was greater when the firms previously relied more on bank loans, when they were small and opaque, so they had didn't have access to other sources of financing, and if they got cheaper loans from the entrants. So these are the bigger firms locally that switch from the incumbent banks to the entrants. Okay, so to the finance folks out there who might not know what we're talking about when we talk about conservatism, I thought I'd just give a very brief primer. So we're all aware of the debt equity agency conflict, right? And we also know that from the balance sheet equation in accounting that assets equals liabilities plus equity. And in finance, we translate that as the value of the assets equals the value of the debt plus the value of equity. So this is Modigliani-Miller, 1958, right? And so if you want to think about it, here's how we present the claim of debt and the claim of equity on the firm's assets. This is from Black-Scholes, right? So the lower figure is debt. So the debt holders get, in liquidation, everything of firm value up to the point of the contracted loan, the amount that was lent, that's X. And equity holders get everything above that, right? And so effectively, if you sort of merge these two graphs, what we're saying is that the value of the claims on the y-axis, the debt and equity, is the same as the value of the assets on the x-axis. So that's the value equation in finance, right? But the nature of risk is different for equity versus debt, because the debt holders don't get any benefit or risk when the firm's assets are above the exercise value of the debt, right? At the point at which the firm declares bankruptcy. So they have mainly downside risk. So they care about when the firm is doing poorly, because that's when their value changes. For equity holders, conversely, they care about upside risk, because for them, their risk is all concentrated when the firm is above that liquidation point. So then If the firm does better, they get more value from the firm. So in accounting, we think about conservatism, and there's a whole lot of confusion about what is conservatism. So one definition, and by no means the only one, is that accountants should anticipate all losses and anticipate no profits. I think of conservatism as falling into at least three main buckets. First is balance sheet versus income statement conservatism. Sometimes they're possibly correlated, sometimes they're negatively correlated. And then the income statement conservatism itself falls into unconditional and conditional. So what do we mean by all of that? So let's think about 2001, when the US got rid of one form of accounting for acquisitions. So previous to that, we had both pooling of interest and purchase method. Purchase method is what everyone now uses. So you sort of record the value of the assets at the market value, the value of the assets you're buying at the market value, the value of the liabilities at their market value, and then the difference is goodwill. Okay. Under the pooling of interest methods, what you recorded was the book value of the assets on the acquired or target firm's books, not the market value. And you did not record any goodwill. So what happens is then that your balance sheet is smaller under pooling than under purchase, because market values tend to be greater than book values, at least when firms are acquiring good targets. But the income statement becomes more conservative. Why more conservative? Well, you report less income because, one, you're depreciating more under purchase because you're depreciating the market values of the assets you acquired rather than the lower book values. And then second, you have this new item called goodwill that also has to be amortized. So there are two streams of income expense that are there under purchase but are not there under pooling. Now, sort of serial acquirers didn't quite like that fact of having more goodwill amortization on their books. So they lobbied the FASB and they managed to get rid of goodwill amortization completely. So previously we would have had this unconditional conservatism where you would have more depreciation and more goodwill amortization every year into the future based on the information at the time of the acquisition. So whatever market values you reported at the time of the acquisition, this would determine your depreciation for the next 10 years or 25 years, and your goodwill amortization expense for the next 40 years, right? So, but this was not, this was all predetermined in the sense of at the time of the acquisition, you knew what the effect was going to be on all future periods. So the FASB got rid of the goodwill amortization and said, instead of this amortization, the steady stream of expense every year, we're going to make it goodwill impairment. Every year, you're going to check if your market value of the assets you acquired has dropped below what you paid for them. And so now there's this periodic impairments that are based on performance. So if your company is doing well, then it doesn't have to do any impairment. But if the company is doing poorly, now suddenly it has a big expense in some periods. So that's what's conditional conservatism. And the idea is that under this conditional conservatism, when the firm is performing poorly, so that's on the x-axis, you have returns. So when you have positive returns, you have small positive cash flows each period. But when you perform poorly, that is the value of the company is dropping, the returns are negative, then you have large impairments or write-downs. And so the slope, the relation between earnings and stock market is stronger for bad news periods than good news periods. And so the difference in the two slopes is what we call conditional conservatism. And if you just think back to that debt payoff picture, this is similar to what the debt payoff function looks like. In the extreme, if you anticipated all losses, your slope on the left-hand side would be -1. And if you anticipated no profits, your slope on the right-hand side would be 0, which would be exactly what the debt holder's payoff function looks like. Okay. Now, accountants aren't quite as strong as that, but the tendency is in that direction. And so we expect that because debt holders have a demand for financial statements, so you can't get a bank loan without providing financial statements. The banks will require that you report conservatively to make sure that they're getting informed when you're doing poorly, so they can intervene and help. So what is the hypothesis? So we argue that when new banks entered, there's two possible outcomes. So one is that the incumbents lost their bargaining power, and so they could ask for less conservatism from the existing clients. And the new banks that were coming in, because they had alternative monitoring technologies, would also demand less conservatism. The argument that the prior literature has used is that the incumbent banks, local banks, knew their clients well. So they relied on relationships with the managers or the entrepreneurs to decide who was a good credit risk and who wasn't. But once these out-of-state banks came in, now this relationship lending was eroded because the borrowers could always switch to these out-of-state banks. And so now there's less incentive to build up the relationship with the local banks. And so now the incumbents would have to demand more conservatism so that to protect themselves from this risk of these clients escaping. And the prior research finds that bank conservatism indeed increased when you look at these incumbent banks. So they were reporting more loan loss provisions and impairments after this act than before. So what we are arguing, though, is that if you look at the client side, we predict the former, so the top part, and that's because the prior tests look only at the incumbent banks because they do different diff tests. You can't do different diffs on the entrants because there were no entrants before 94. So you can only run the tests on the incumbents, and the incumbents may react differently than the entrants. So by not looking at the entrants, you have only a partial story. But if you look at all the firms in a state, now you have a more complete story of what the incumbents and the entrants are doing. Okay. And then the second hypothesis then is that the amount of conservatism demanded before and after that change is going to depend on how strong the incumbents were before or how weak they were after. So the change in their bargaining power. So we argue that the stronger they were before, the less they would be threatened by entrants. And so the impact of IBBA would be less, so there would be less impact on conservatism. How do we test? Well, our research model design is pretty standard. It's basically taking the graph that I showed you earlier and converting it into regression form. So the first part, the alpha and the beta, that's just the positive slope. And then the beta 2 and beta 3 is potentially different intercept, that's beta 2, and a different slope, that's beta 3, for negative returns, for bad news. Okay. And here we're going to focus on the accruals rather than total income because we know that these write-downs are accrual numbers, so impairments are accruals, not cash flows. So we're going to focus on the accruals piece. And then to test the effect of this IBBA, we're going to interact and index on how much a state opened itself to interstate branching. So the index is going to run from 0 to 5. So before IBBA is going to be 0, and after IBBA it's going to run from 1 to 5, where it's basically, did they adopt any of the provisions? And for each provision of the 4 that was adopted, your restrictiveness drops. Okay. And or alternatively, your openness increases. So 5 is most open and 0 is least open. So the prediction is that the more they open, the more negative this coefficient will be, because that's the biggest effect on conservatism, but we expect conservatism to decrease. We also have controls for each state with all the variables in that regression, in the basic regression, and controls for year with all the variables in that regression. So we already have a control for each of the years when IBBA is taking place. What we're looking for is the incremental impact of how much you opened within a given year, holding sort of year fixed effects for the whole US constant and state fixed effects for each state constant. Okay. So if we look at earnings as dependent variable, which is a sort of traditional variable, we find a negative coefficient. And if we look at the accruals component of that, we find, in fact, a slightly larger negative coefficient. But when we look at cash flows, we don't find a significant effect. If anything, it's positive. Okay. Now, these coefficients are a bit smaller than we used to in the conservatism literature, but that's because we have all those state and year conservatism regressions in the background as control variables. So this is just the impact after controlling for conservatism differences in each year and conservatism differences by state. So say red states versus blue states, New York versus Arizona, all of that. After you control for all of that, this is the impact, so like a 2% or 2.02 change in the conservatism, which is sort of 5% of total conservatism in this period. Okay. Next, we want to sort of look at the H2, which is sort of this incumbent power. And we look at sort of several different measures. We look at the size of the biggest banks in the state. So we look at the top 10 or top 20 banks in the state as a percentage of the total top 20 banks of all the states in terms of relative size. Or we look at the number of big banks that had assets either greater than $5 billion or $3 billion. Or we look at the number of potential big entrants nearby, so within 25 miles, so neighboring states, basically, if there was a large bank in a neighboring state. And what we find is that after controlling for everything else in that old first regression, now when we add in this incremental piece, we get that if you have these incumbent banks that are powerful, then you get less of an effect, less of a decrease. So the decrease is in the top row, the black row, but you get a less of a decrease if you have powerful incumbents. And then at the bottom, we have, if you have more likely to have entrants, then you get a bigger negative effect. Okay? So again, the signs are consistent with our predictions. Then we look at, okay, the firms themselves. So which firms are more likely to be affected? Well, we argue that firms with bank loans already are more likely to be affected than firms that did not have bank loans before IBBA, because there's a sort of self-selection. And what we find is that the firms that had bank loans before IBBA had a much bigger decrease in risk-taking than the firms that didn't previously have bank loans, although they also decreased their risk-taking. Other monitors. So what happens if banks are not the only people demanding conservatism? Well, if you think about institutional ownership, there are papers by Ramalinga, Goda, and Yu that sort of argues that they would demand more conservatism and show that. And then if you think about analyst following, again, the papers that show that analyst following is correlated with conditional conservatism. And so here we look at whether these are correlated with the change in conservatism related to the index. So, and what we find is that the effect of the openness is reduced. So you have a smaller decrease when you have strong institutions or high analyst following. And lastly, people asked us, okay, so is conservatism the only thing that banks would change? And so we looked at governance. And so the idea was that if banks, the incumbent banks lose bargaining power, then they should presumably have less ability to set governance. And so we look at the number of governance, the net worth governance, and the current ratio governance. These are the bottom two are the two most frequently used governance. And what we find is that the number of governance decreases after IBBA, and especially driven by the net worth governance. So these are now all banks. So we have, so Salma's question popped up in the chat. So these are all, so these are all banks, but we're basically looking at the client side, right? So we're not looking at the banks themselves, we're looking at the firms in each state. And we're looking at their debt contracts, so deal scan basically. So we're looking at their loans that they've got from different banks, but partitioned by whether they are in state or out of state, lead banks. But basically looking at the client side of this, not the bank side of this. So we've got all banks, public or private, so long as they're in deal scan. We do sort of dozens and dozens of robustness checks and parallel trends, controls for firm characteristics, other law changes, excluding regulated firms. You can see there's a whole bunch of things that you get as part of the review process, right? So, but our results are robust to all of this. Different methods of estimating conservatism, Ball and Shivakumar, Dutta and Patatukas, et cetera, et cetera. So we're pretty convinced that's a robust finding. So now let's move to the finance paper. So here, the argument is that, again, the traditional argument is that new bank entry increases bank competition. And because the banks now have to fight over a smaller pie of clients, they're forced to lend to riskier clients to maintain the market share, or at least maintain the same level of deposits and loans, right? Because now they're new entrants, new banks fighting over the same pool of potential borrowers. So the traditional argument is that the banks would then increase their risk taking. And there are indeed several published papers that show, using different specifications, that both public and private banks increase their risk taking. And at least in the US, we have data on both public and private banks through the Federal Reserve and other agencies because of specific acts. The flip side of the argument, though, is that the incumbents would lose bargaining power, and so they would charge lower interest rates, and then the clients wouldn't need to take on as risky projects to meet the hurdle, right? The risk-return trade-off. And the second thing is that relationship lending would decrease because the incumbents would no longer be able to compete simply by knowing the client. The client could go to a big bank that doesn't care who they are so long as they're creditworthy. And that would also sort of reduce the need to take risk. And so our prediction is that risk-taking fell more around IBBA, again in states with more openness. And so here's what we see in the data. So if you separate out the banks that were there before 94 and the banks that entered after 94, and you look at the interest rates that they charged in all their loans and deal scan, you see that the incumbent banks, the black line, they stayed more or less constant, or if you go back far enough, the interest rates increased, right? So if you look at this area, it looks like there's an increasing slope in the interest rates. But what's not taking into account is this sort of the green line at the bottom. So the incumbent banks are coming in, the out-of-state banks are coming in, they're charging lower interest rates, and they're grabbing a bigger share over time. So this interest rate is actually going sort of like this, in this, if you look across both the incumbents and the out-of-state banks, because the incumbent banks are getting a smaller and smaller share of the total loans. And we can see that, so when the previous papers did the black line, they basically assumed that the entrants would have the same type of loans as the incumbents. So they drew conclusions based on the diff and the incumbents. The problem was that the out-of-state banks are larger and charge lower interest rates. So you couldn't take their results on the bank side, that they were charging higher interest rate or having more write-offs, simply because there was a shift in the clients from those incumbent banks to these new banks. And basically the larger, safer clients all fled to the new banks because they could get better services and lower interest rates. And if you look at the size of the loans for these two groups now, the incumbent banks, again, did not change much in that immediate period. But if you were to take sort of the early years, you would sort of see this decline in the size of loans for the black sample. But really what's going on is that the big companies are all switching over to the large out-of-state banks, the Bank of Americas, the Citibanks, the JP Chase Morgans, the Wells Fargos. And so what's happening is that there's this change in the clientele in the incumbent banks. And that's making it look like you have smaller loans, even though really overall loan size may be increasing once you take into account both groups. Okay. And so this is what I meant about a small problem with the definitive tests that prior research has run. Even though they looked at both public and private banks, because they were doing definitive tests, they ignored the out-of-state banks in each state. So they looked at only the incumbent banks. And the sample selection bias effectively is unrepresentative of what was going on in these states. And then the second sort of hypothesis along the same lines is that the incumbent bank power is going to affect how much the risk-taking changes. So how do we measure risk-taking? Well, the primary measure we're going to use is the volatility of EBITDA to total assets over the previous 4 years. Here we're following a finance paper because my co-authors are finance folks. And there are two other risk measures also based on earnings volatility. One is earnings volatility of the firm relative to the average volatility of other firms in the state. And the third risk measure is the difference between the highest and lowest earnings to assets over the 4 years. And these are all different finance papers that use these measures. Fourth measure that we use is stock return volatility. The problem with stock return volatility is that it's affected by leverage, whereas these measures, the accounting measures, because they're undoing interest, is not affected by leverage. So it's more about the assets, asset risk. And then as accountants, as an accountant, I decompose the earnings volatility into cash flow volatility, accrual volatility, and the covariance between them. Okay. And what we're going to see is that I'm going to show you results only for risk one. And for the accountants, everything is driven by changes in the operating volatility. Okay. Operating accruals, not the cash flows. So it's going on in this accounting side of the things. Okay, so the research design here is simpler because we have the risk measure. We don't need to estimate any more slopes. So all we need to show is that this risk measure, controlling for everything else that might affect a firm's risk, is affected by this RS index, which is this IBA openness index like before. And we have controls for firm year variables, state year variables, industry year variables, firm fixed effects, year fixed effects. So we control for basically a kitchen sink approach, anything that could affect earnings volatility. And so the initial test is sort of looking at just the client side. So we look at firm size, leverage, Tobin skew. We look at industry, product market competition, labor force concentration, and then we look at state growth and personal income growth. And controlling for all those other things, we find that the RS index has a negative coefficient that's statistically significant. It's clustered at the state level, like other finance papers. And the economic significance seems reasonably large. So compared to the mean of risk one in our sample period, this is a 10% decline in risk taking by the clients around this opening. If we then look at bank characteristics as well, so the number of top banks, the number of large banks in the state, the share of deposits in small banks, the deposit concentration ratio, and then the firm's own loan loss provisions or charge-offs. After controlling for all of that, we have basically the same coefficients. So none of that seems to be, even though it affects risk-taking, none of that seems to be driving the effect that we are capturing in the years in which the firms change their the states change their openness by different degrees. Okay, so controlling for everything else that's going on that we can think of, there's still this sort of 10% effect on risk taking in those years. To look at how influential incumbent banks affected, or how big incumbent banks affected the index, because the out-of-state banks are the same large out-of-state banks. We look at reliance of the clients. And so we look at whether there was a bank loan before IBBA, just like the first paper, whether the firms are small or opaque. And then we look at the change in the interest rate. Did they get a bigger decrease in the interest rate than the state median? Did a particular firm get a bigger decrease? Or did it borrow from out-of-state banks after IBBA rather than incumbent banks after IBBA? And so if we look at, for all of these, we're predicting negative coefficients. And so we find that if a firm had a prior bank relationship, then it had a bigger decrease in risk-taking than if it didn't. If it was a small firm, then it got a bigger decrease. And if it is opaque, and these are proxies for reliance on banks as opposed to public debt or other kinds of debt, then, so access to public markets basically, then again, they had to take on less risk after IBBA than before. And if we look at the source of their financing, so if we look at, did they get cheaper loans or more cheap loans than the average firm in the state did based on the average change for after IBBA, then firms that were more affected by IBBA basically got a bigger reduction in risk. And if they're borrowing from out-of-state banks, these new entrants, they had a bigger decrease than firms that continued borrowing from incumbent banks or took on new loans from incumbent banks. So that's also consistent with our story that the new banks basically took on bigger clients, less risky clients. And so they firms that could take on these large capital investment projects were more likely to get financed by these large banks. Again, we do a bunch of robustness stuff and more related to volatility, like looking at high VIX periods or recessions, but we also do the parallel trends test, placebo tests, look at neighboring state deregulations, a bunch of different stuff. And again, we come to the same conclusion, our inferences are not changed. So to sort of sum up, we find that borrowers' conditional conservatism and risk-taking decreased after IBBA in predictable ways. The inferences depend heavily on whether you include banks or you exclude them in your analysis, in your different diff. So if you look only at the incumbents, then you might get different results than if you look at both incumbents and entrants. The traditional different diff design looking at the bank side cannot incorporate those entrants because you don't have data for them in that state before they enter. But looking at the clients allows us to combine both entrants and incumbents. And so we are getting different results in prior literature. So the sort of takeaway is that this deregulation affects the borrower's risk-taking and reporting, which in turn affects firm wealth and shareholders and stakeholders in general welfare. And so this may be an unintended consequence of IBBA. IBBA was intended to help banks, but the sort of spillover effect is onto firms and then their stakeholders. And that may not have been the intent in the act, but certainly we've benefited from relaxing archaic regulations that were set in the 1860s and the 1930s that may not be applicable to today's world. I assume that if we'd been live, we would have been at the Kingston Business School for this conference. So I thought for those who haven't been there, leave you with a picture of Kingston. Thank you.
Great picture. Thank you, Sudipta. Thank you so much for your presentation. And we don't have any questions in the chat, but I wonder if anybody has a question, just raise your hand or unmute or type your question. And okay, so we have a question from Hussein. Hussein, you want to ask the question or shall I ask it? So Hussein says, I expect the author to consider the effect of managerial overconfidence on conditional conservatism if they pay close attention to the results of this research. And there's a link here.
Sorry, Salma, we cannot see the question.
The comment, I think it was just directed to me. Sorry.
Okay.
It is a very influential factor in conditional conservatism. So there's a link to a paper here, the effect of managerial overconfidence on the conditional conservatism and real earnings management, Salehi et al., including Hussein. So yeah, Hussein, one of the co-authors. Hussein, do you want to add to that? Because nobody else sees the question but me.
Can you copy paste in the chat?
Ma'am, shall I ask the question to?
Yes.
Please.
Sir, actually, I have done some of little research in the NPAs and all. And since I think my question will be the relevant for the session, why don't we have a collaborative effort from all the agencies towards recovering the NPAs of the bank? I means this is slightly different, but NPAs related your point of view regarding collaboration of all the agencies is really needed somewhere, but how this is addressed by the RBI nowadays? Can you put some light on it?
So can you just expand NPA and RPA for me, since I'm not British? So what do you mean by NPA and RPA?
Not RPA, it's a non-profit assets.
Okay, non-profit organizations. Okay.
Non-performing assets of the bank. The loans are taken and then people becomes a fugitive and all. These all things are happening in India nowadays. And so I am really worried about the financial system right now. How can we recover from the scenario?
That's pretty far from our paper, but okay, let's try to take a crack at that. So in India, fortunately for us, we have a lot more digital tracking than we do in, say, the US, right? It's possible to trace people's activities much more than it is in the UK. So we're more a surveillance state like China than we're like the US. And so, you know, the government can basically track all of your bank accounts. They can link it to your activity. They can freeze your accounts and all of that. So it's much easier in some ways to recover assets. And especially now that we have these money laundering controls around the world, you know, the Panama Papers and the Swiss banks opening stuff and so on, revealing information, it's now much easier to track these assets that people try to take offshore because of those sort of agreements that attempt to reduce this offshoring of wealth, basically. No system is perfect. Criminals always figure a way around the rules, but it's become harder for them to do it than it used to be in the past.
Thank you, sir. I am really satisfied with your answer.
Okay, and then to come back to your overconfidence question, yes, overconfidence is potentially related to conservatism. I actually have a different working paper that sort of shows that those results fall apart if you do the conservatism test properly. But that's a separate issue. You can look it up on SSRN. Even if that result holds, okay, the question is, why would it be affected by this change in regulation in a given year and the amount of openness, right? So that's a much harder sort of logical thing to think about. So we're controlling for year fixed effects, we're controlling for state fixed effects, we're controlling for lots of state firm related variables like size, book to market, all of that, which prior literature also correlates with overconfidence. So after controlling for all of that, thinking of a logical reason why that overconfidence should change proportional to how much a state is opening banks to competition, not even the firms, but the banks. So why should the firms' overconfidence be affected by banking regulation changes? That's going to be a very difficult logical train. Okay? So, I mean, it's possible, anything is possible, but it seems unlikely.
Thank you very much for providing valuable information.
I think Amir was unmuting and then remuted. So Amir, did you have a question? Comment?
Amir?
Oh, no, ma'am. No, ma'am. No
No.
question.
Everything is perfect.
This morning's paper also was quite interesting, where it was looking at trust in the financial sector. And it was interesting to see that trust by those in the financial sector, how they trust others, has actually declined over time. Maybe not in the same period that you have, but I think it was from the early 90s up to recently 2019. And the trust of the people within banks seems to have declined during that period. But I think that it could go the other way, where it may be that the companies themselves are skeptical in their relationship with the banks somehow. I mean, not related to this paper. I don't think it will have any effect on the conservative or the borrowing, but just something to maybe consider.
Well, I mean, we know from the Wells Fargo scandal that, the banks are putting pressure on their agents to get more clients to compete. And so then at least some people are taking shortcuts and there are big fines being imposed. And so, yeah, I mean, the fact that you're putting so much pressure is going to reduce trust within the bank and then between banks and clients. So if there's pressure being put on clients to create new accounts, or new accounts being created in clients' names without them knowing about it, there's going to be lots of problems, right? So, but again, Wells Fargo is not the rule, it's an exception. So I don't want to make sort of generalize too much, but even one example makes people question what might be happening at their own banks, right? And then the global crisis could not have helped because that a lot of banks were involved in that, in the sort of securitization and the marketing. So I think that did not help banks cause either.
Yeah, and it is interesting to see that they're deregulating, more deregulation, where, I mean, in the UK, everywhere else, it's more regulation rather than less. So.
Well, again, it's reversing, it sort of goes back and forth, right? But it's overall less regulated than it used to be. So Monamita, you had a question or comment?
Yeah, excellent presentation, sir. I want to, it's not a comment. I just want to clarify one thing, that when I read IBBEA regulations, how I see the impact that it is allowing more banks to establish a relationship with their clients, because their clients are the companies and their clients are also behaving in a very different way when they are dealing after this regulation. So is it something that whole monitoring power is quite disturbed after this type of regulation, and can we conclude that this type of regulations are not helping at all to strengthen the financial stability somehow in these countries?
So sort of thinking about financial stability first, it sort of depends a little bit about how you define financial stability. So from the bank side, obviously financial stability is when the bank fails, right? So the US has thousands of small banks. Most countries have a few larger banks. They have small banks, but nowhere near the scale of the US, simply because in the US, the regulations force banks to be small. Until the 1970s, banks could not have branches in other cities sometimes they were restricted to the city, not even the same county. They couldn't go beyond the city limits in terms of opening branches. So banks were forced to stay very small until the 1970s. And so it's only after the 1970s that, say, bank holding companies, that you could buy two banks under one bank holding company. That was a way to get around sort of these restrictions. But even that was limited to within your state and so on, or sometimes within your county. So banks had very little diversification. They were very tied to the local economy. So just think about the coal crisis in the UK in the 1980s, right? If you are a bank in Wales and you had suddenly this stop in coal mining, suddenly you're exposed. I mean, people are not earning anything, they're not depositing money, people are trying to get loans, suddenly you're in high risk of failure. Same thing 5 years ago in the US when coal mining in West Virginia was stopped, right? So suddenly banks that are highly exposed to a sort of very idiosyncratic risk that they have no control. Right? So in that sense, this deregulation allowed banks to diversify geographically across all the states, and sort of by bringing down Glass-Steagall, allowing banks to have both investment and commercial activities. So you had different businesses as well. So you were not as exposed to one business as another. You could offset basically. So from the point of view of the system as a whole, that for the banks, the bigger banks at least became more stable. The smaller banks obviously became less stable because they might not have had the capital to expand. But on the other hand, they were not providing as good service overall in the sense of because they weren't diversified in the deposits, they couldn't charge as low interest rates. So they're charging higher interest rates than the large banks. So that's why they basically start to keep shrinking. Right?
Yeah. Yeah.
So now if you think about the global system though, this too big to fail is sort of a regulatory choice. It's not required, right? So when Lehman Brothers failed, the Fed decided not to intervene, even though Lehman Brothers was a very big investment bank. But it's when the next one failed that they decided to intervene. The question is, what would have happened if they hadn't intervened in the second one? Right? We don't know. We know that the first one didn't create much damage. I mean, all the clients shifted, all the employees shifted, and basically everything was redistributed. Shareholders lost money, but someone else gained money, right? So I mean, the shareholders of the other banks gained money, the ones who didn't take on the risks.
Yeah.
And so now, I mean, it's a redistribution. It's not clear that you gain much by stabilizing the system and subsidizing inefficient or overconfident managers and banks, right? Imprudent managers and banks.
Yeah.
So you might actually destabilize by using too big to fail rather than stabilize. You stabilize in the short run, but in the long run, you make it more fragile or unstable because people who take on big risks are not getting punished. They're being bailed out. And that encourages them basically to be even more irresponsible in the future because other people are bearing the cost.
Thank you, Sudipta. Thank you. So thank you for your presentation. Over to you, Salma. Yeah.
Thank you, Sudipta, very much for your presentation and for your contribution, for being here. It's much appreciated for us here at the UK, in the UK. So if you don't mind, I will stop your screen sharing, and because we do have to move on to the next speaker, and hopefully you can stick around.
I plan to.
Great. My PhD colleague, I haven't seen her for ages, so I will leave it with you, Mono, to introduce Nerissa.
Yeah, thank you. Thank you, Salma. So I would like to welcome Nerissa Brown. She is an associate professor of accountancy and academic director for the BSA and MS program in accountancy. And she is also the PwC faculty fellow and R.C. Evans Disruption Fellow at University of Illinois. And it's too many things. She is a really great speaker, and I'm looking forward for her talk. And she holds a PhD from the University of Maryland in 2005, and was previously at the University of Southern California, Georgia State University, and University of Delaware. She was an academic fellow at the U.S. Securities and Exchange Commission in 2017 and 18. And her research is mainly focused on financial reporting and non-traditional disclosure in the capital market context. And her research on non-GAAP earnings has been featured in media, and there are several other working papers, and she keeps on publishing, and so you can follow her paper. So very nicely written papers on current issues. So over to you, Nerissa.
Thank you.
Welcome.
Yeah, thank you, Manumita, and thanks to Salma for inviting me to present today. So Salma and I go way back, and I mean it's been years since we reconnected. So we were PhD colleagues at University of Maryland, and I still remember that big corral where all the PhD students would sit together and kind of learn from each other. So it's definitely a pleasure and honor to present today on broadly about disclosure research. And my presentation will just give an overview of the literature and also include several of my papers kind of interspersed into the discussion. And my discussion will focus a little bit more on newer things that are happening in the disclosure space. So let me go ahead and share my screen. So can you guys see the slides or the notes view?
I think you have to do full screen, Nerissa.
How about now?
It's still not coming. I think you have to click once more.
We see the slides, but not in presentation mode.
Yeah.
How about now? Do you see it in presentation mode?
No, not yet.
Okay.
Yeah, I think if you share
Slides
once
have
more,
gone.
it will work. Let's try once more. Yeah, it's working now, Nerissa.
Sorry, I have like 3 screens and it's always hard to figure out like which screen it shows up on.
Yeah.
So I was asked to, come up with a catchy title for today's presentation. So today's presentation, the title is MMA of Disclosure Research, where MMA, refers to media, mobility, and analytics. So the newer things in disclosure research that I'll, kind of focus on today. So in the spirit of that catchy presentation title, I here have, kind of a picture of traditional boxing versus mixed martial arts. So I grew up as, a pretty big boxing fan. I'm originally from Jamaica, and we had a couple of boxers that are of Jamaican descent that actually competed for titles, in the heavyweight and lightweight categories. So kind of on the big stage. So I can remember back then when it was fight night, we all like got together and, sat in front of the TV and kind of cheered our local boxers on. If you follow the sport, you notice that the hype around boxing has kind of declined a little bit, as some of the big stars have retired, etc. And now things have moved over to mixed martial arts. There's the UFC that's kind of pretty big. So in that spirit, the first part of my presentation, I'll talk a little bit about kind of the basics behind disclosure. So, what are some incentives and factors that are in play when firms decide to voluntarily disclose information or not? So what drives them to actually get into the ring? And then the next part of my presentation will focus more about how and where to disclose. So the newer style of, you would say, competing in the ring with respect to disclosure research. I'm going to talk a little bit more about social media, mobile technology, and analytics, both from a textual standpoint as well as from a machine learning standpoint. And I'll discuss, several of my papers, both published and working papers kind of within this space, and try to just, show you a little bit about the findings that we have in those papers, and happy to get some feedback on our results as well. And I'll also discuss, some challenges that we face in kind of working in this space also. So to just start out with, what are the factors that are in play when firms decide to voluntarily disclose information or not? When I teach my PhD class, I always tend to start off the class with kind of this graphic, which comes from a financial accounting theory textbook that I use in the class, which talks about the economic role of information in capital markets and why the disclosure of information is important in allocating scarce resources from investors and creditors to firms. And so, as you can see here, the general theory here is that from an economic standpoint, resources are scarce. We as investors, and Sudipta talked a lot about banks, lenders, we offer resources from a financial standpoint to capital markets, and the capital markets then allocates these resources, hopefully efficiently, to firms that are likely to use these resources in the best way to generate a return for investors and creditors as well. And if this allocation of resources, if it's optimal or efficient, there's broad welfare maximization across capital markets and society. It creates a public good. However, to ensure that resources are allocated efficiently, we need information. So as investors and creditors, we need information to discriminate between good firms versus bad firms. So which firms are likely to generate a higher shareholder return, which firms are likely to repay loans, etc. Now, a lot of the disclosure in the capital marketplace is mandated because without mandatory disclosure rules, firms, while they have incentives to disclose information, these incentives only drive partial disclosure and not full disclosure. And I'll discuss this a little bit more. So disclosure research focuses on factors that drive the supply of information from firms to capital markets, and what are the consequences of these disclosure behaviors. And a lot of my research focuses on voluntary disclosure and the extent to which voluntary disclosure strategies can be strategic, and how it impacts investor responses and judgments, etc. So as I said, market need information to allocate resources. However, there is also the concept of information asymmetry. There is a separation between ownership and management. So even when we as investors provide capital to firms, we are essentially the owners of the firms. We're holding the equity, and we are delegating actually running the operations of the firms to management. And so this creates an information asymmetry problem. There's adverse selection as well as agency problems. And so, you know, even with that, there is the question of, well, do managers have incentives to fully disclose firm specific information? Typically, the answer that you'll find in the theoretical literature is no, they do not have, you know, full incentives to fully disclose, but there are incentives to partially disclose information. And there are some barriers on why firms do not want to, or managers do not want to fully disclose information. But from a partial standpoint, here are just some general incentives that are in place in the capital markets for firms to reveal information, at least partially. So, and I'm talking here more about voluntary disclosure and not necessarily about mandated disclosures. So mandated disclosures are put in place to at least get firms to bear the cost of actually collecting and generating disclosures or information and then providing that to the capital markets. Most of the disclosure rules, when you think about things from a financial statement standpoint, focuses on general purpose financial disclosures. Outside of that, a lot of the disclosures that we do see fall into the realm of voluntary disclosure. So the incentives that are in place, we have contractual incentives. So they can be incentives to disclose that are embedded in contracts that are put in place between shareholders and managers as well. There's a lot of market-based incentives. So managers, they have their own reputational and career concerns at play when deciding, okay, how much do I disclose to the market about the firm, its operations, and what they are actually doing to improve firm performance. So there are incentives for them to disclose information, especially positive information, if this reflects positively back on their reputation as well. I've already talked about general capital market incentives, the fact that the flow of capital between investors and creditors and firms, the flow of capital is more efficient when there's more information within the marketplace about the firm. So when we decrease information asymmetries, then it enhances the flow of capital between investors and creditors and firms. And so generally there are capital market incentives if firms wish to raise capital for them to partially reveal information. There's also incentives to reveal information to reduce takeover threats. And also there are product market incentives with respect to here, more with respect to, you know, creating barriers to entry, et cetera, with respect to other firms entering into the marketplace. But generally in the literature, even though these incentives are in place, there is a trade-off with respect to whether firms disclose information or not. The general rule is that firms will disclose information when the benefits are at least equal to or greater than the actual costs of providing this information. And this is why it's important to have mandatory disclosure rules in the sense that preparing financial statements, getting them audited, et cetera, the firm bears a lot of these costs. Of course, they reap benefits based on the allocation of capital, but the general notion is that if these mandatory rules aren't in place, it's questionable whether firms would actually bear the cost themselves to provide this information. So here are just a list of some of the benefits versus the costs that you'll typically see in the literature. From a contractual standpoint, there's benefits to disclose information if it has implications on managerial compensation. Again, their reputation and labor market concerns. Providing more information, again, reduces information asymmetry. It lowers the cost of capital. It helps to generate more accurate investor expectations with respect to firm performance. And it also generally increases liquidity. Just to touch a little bit on the costs, the literature talks a lot about proprietary costs. And so when firms voluntarily disclose information, they're not only just revealing information to investors and potential creditors, but they're also revealing this information to competitors, labor unions, regulators, etc. There's also the cost with respect to producing information and actually verifying the quality and the veracity of the information that's being disclosed. And also the literature does touch a lot about litigation risk. So when you do disclose information, it can actually heighten litigation risks on one side, but it can also reduce litigation risk on the other side from a benefit standpoint, because at least you are more transparent with investors, but at the same time, when you disclose information, sometimes it opens a door for litigation if there are potential errors, whether these errors are unintentional or intentional. It opens a door for, litigation actions to be filed against the firm. So here are some research challenges that we generally face in doing disclosure research. This is something that I still struggle when, writing a disclosure paper. First of all, many cases, it's hard to disentangle the benefits versus the costs. And this is something that you'll generally still see in the literature. We typically can only observe the net benefits or the net costs. There is also issues in actually measuring the actual benefits versus the costs. So, if we think about litigation risk, that is always difficult to estimate. There are models within the literature that can help us to estimate litigation risk, but it's always questionable how accurate these models are. But of course, the models that are out there, gets us a little bit closer than having no estimation models at all. Sometimes if you just focus on firms that are actually sued, of course, sometimes then you're only focusing on the tip of the iceberg. So the firms that actually do have problems, and the firms that shareholders and regulators do decide to pursue cases against. When it comes to cost of capital measures, there's a ton of literature on the measurement of capital, cost of capital, and the fact that a lot of our measurement is actually based on analyst forecasts, which can also be biased. There's always selection biases to grapple with. As Monomita pointed out, I do quite a bit of research on non-GAAP disclosures, which is a voluntary type of disclosure. And we always have to address selection issues there within our papers, mainly because firms that choose to disclose have likely decided that, hey, we're going to go ahead and do this because the benefits seem to generally, or they believe the benefits have or will outweigh the costs. So the firms that disclose, of course, we're only observing those firms that have decided that, okay, likely the benefits are greater than the costs, and we're going to go ahead and disclose. So because of these selection biases, you'll notice that in the disclosure research, there's always a lot of robustness tests that are built around dealing with endogeneity. Of course, there's no perfect solution to dealing with endogeneity, but there are, of course, very sophisticated ways in actually making sure that, you know, you can control for endogeneity as best as you can. Of course, you can never sometimes make causal statements, but, you know, with techniques such as like propensity score matching, entropy balancing, using exogenous, you know, shocks, even though I don't like the word shocks, sometimes, you know, it can help you to craft your message a little bit more where there's not huge concerns about endogeneity. Another thing too is, especially when we look at the consequences of disclosures, we see investors respond. So sometimes we look at a price reaction, but there's always a question of, oh, well, is the price reaction correct? Are investors overreacting or underreacting to disclosures? And sometimes if they overreact, especially to bad news, this can actually discourage managers from voluntarily disclosing information, or make it so that they try to be more strategic in how they voluntarily disclose information, especially bad news. So of course, we can always look at, let's say, future returns or future price reactions to determine, well, is the disclosure actually useful to investors, or was the reaction appropriate at the time that the disclosure was made? But there's still always difficulty in, again, using stock returns and stock prices to gauge whether the disclosure itself was decision useful. So let me now turn to, so those were the basics. So let me now turn to, okay, what's being done in the space with respect to disclosure, but now focusing on new aspects of disclosure. So here I'm going to talk about media channels or new media channels, for example, social media. I'm also going to talk about analytics, as one key aspect. And here I'm also going to talk about mobile technology. So the fact that access to information is now at our fingertips, especially through mobile devices, what does that mean from a disclosure standpoint? And specifically, what does this mean for the flow of information into capital markets? And again, there's challenges in doing this type of research as well. Now, to kick off this discussion, I'm going to use a financial communication framework that is in an AOS paper by Liz Blankenspor in 2018. It actually sets the stage pretty nicely, and she presents a pretty nice graphic on how, you know, the disclosure model actually works, and then how this model actually changes when you introduce new media channels such as social media. So in her framework, she talks about disclosure broadly. So what are firms disclosing? Are they disclosing information that's fairly objective? Let's say objective disclosures, let's say from a financial statement, where we know, of course, there are issues with how, you know, things are measured. But let's say if we take that firms are following GAAP or IFRS rules in computing, let's say, net income, and they're doing this fairly objective, then okay, we're disclosing objective information there. Or are we disclosing information where it can be a little bit subjective, where they can be, you know, spin coming from managers as well? And whether the disclosure is quantitative versus qualitative. Her model also talks about how these disclosures are being provided to the marketplace. So what is the medium? Is it text, imagery, video? What are the attributes? And we can think of like tone or sentiment or readability. Also, who is the presenter? Is it like the CFO or CEOs during a conference call? What is their point of view? And potentially what are some presenter attributes or biases that come to play? And then we talk about dissemination. So again, this is more related to the how, like what is the actual channel? So let's say you're presenting text or imagery. Is this going to be done through a press release? Is this an SEC filing or through social media? And then how does this impact investors' response? Now, generally, investors' response, at least in traditional media type of research, we tend to focus on more a one-way type of response where firms disclose information and investors respond either, say, in trading. Of course, they can vote with their feet, or potentially, maybe there's a response from a litigation angle. When we bring in social media, the response is less one way, but actually more two way. So if a manager tweets something on social media, investors, both actual and potential investors, can actually respond back to those tweets, or they can reshare those tweets as well. So the disclosure angle there, or investors' response there, is a little bit more fluid than just, say, a one-way disclosure response. And then she talks about management response. So of course, this all happens in a loop. So potentially managers will see how investors respond. They can either disclose more information. They can either ignore investors' response, and then they can take this all in and adjust their future communications. So in talking that through, this is kind of the graphic that she presents in the AOS paper. So as you can see here, she has these little bubbles where information is disclosed and then disseminated to investors, and dissemination can be through various channels. And investors then extract and interpret the information. They assess the credibility and then use this to form a basis for their response. And the response can be either public, private, or from a trading standpoint, which then, as I said before, generates feedback to managers where they can adjust their disclosures going forward. So taking this model holistically, I'm going to focus on some key things in discussing media and mobility, more in respect with social media and mobile technology. And I'm going to wrap up with just talking about analytics. So how textual analytics and machine learning algorithms have changed the space in how we can look at the attributes of narrative and nonverbal disclosures, and also presenter attributes as well. Is there anything in the chat?
Yeah, and no, not yet, Nerissa. Yeah, we will pick up the questions at the end. Yeah.
Okay.
Thank you.
But you are happy to take questions as you go. So please, if anyone wants to ask questions, feel free. Good.
Yeah, feel free to put questions in the chat or just interrupt me. Okay, so from a social media standpoint, disclosing information through social media can, of course, change this dynamic. One of the main changes is the fact that when you disclose information via social media, it really enhances the dissemination of information to between managers and investors. So not only are you reaching actual investors, but also potential investors. And this is something that, really played out this year when you think about what happened with GameStop and Reddit and, all the frenzy in the marketplace. You put something up on a message board or through a tweet, and you know, the potential individuals that you reach is very much amplified. George, you had a question?
No, just so Sudipta's question, and I think it's interesting. I would share this question, and I think you might want to take about the analysts. Well, sorry, Sudipta, I don't suppose to ask your question. Where do the analysts fit in this frame of disclosure
Yeah,
of
good
information?
question. So the analysts would somehow fit here, you know, if we think of them as an information intermediary on how information is, you know, potentially repackaged. So they could either fit here from an information extraction standpoint, or they could fit here as being a type of channel, you would say, because they then would take managers' disclosures potentially and repackage it or distill it so that it's easier for investors to consume. So great question. We could think of analysts kind of being somewhere either here or here as well.
They could also be in the third arrow where they give feedback to managers. So I don't see, because the analysts may also be interpreting what the investors are saying and distill it.
Right.
And
Yeah.
because they're getting information from the buy side, for example, that you know, is different from what we normally think about, which is the small investors and their trading activity. But
Yeah. We could definitely, if we think about this as a loop, so there is, you know, definitely papers. For example, there's a paper by Michael Clement in JAE, which talks about the fact that analysts do use, let's say, stock returns, which is coming from investor response. They use that information to then help them, you know, produce better forecasts, et cetera. So they are like taking in information from the marketplace as well. So as an information intermediary, they can kind of sit anywhere within, you know, these arrows between kind of this space, and here as well.
But then they also collect information from other sources. So now the loop is much broader than what the firm is disclosing, right?
Right. So this framework, you would say, is limited in the sense that it's really just focusing on financial communication from the firm itself. However, we know investors and analysts, if you think of them as even a sophisticated type of investor, they're not only just looking at the firm's specific disclosures themselves, but they're taking in information from competitors, you know, macro information as well, and kind of, you know, packaging that for investors to consume. So from a social media standpoint, you know, this part of the literature is definitely growing. Of course, one of the barriers in doing this research, of course, is the data. It's very costly to get tweets, for example, from Twitter. You know, I've gotten quotes from Twitter to get tweets, and the costs can be very, very high. They do limit how much you can scrape out of their API. And I know one of my co-authors that I'm working with, he actually has several servers in his office where he actually is like just gathering daily tweets from companies, pretty much, you know, very much like just every day, just so that he is not like faced with the limits from Twitter in getting into the API. So from a social media standpoint, as I noted before, it enhances the ability to push information to large, diverse groups of investors and also customers. So I've started collecting tweets for one project from social media accounts, particularly Twitter, for the S&P 1500. And one thing, as we started collecting this data, is we have firms that have many different accounts, because these accounts target different types of individuals. So they'll have an account that's directed to investor relations. They'll have an account that's more consumer and marketing related. So sometimes there are like 3 different accounts that we kind of have to monitor the tweets from. Now, one thing we do see, especially when we're looking into this data, is whenever firms have earnings conference calls, there is kind of live tweeting. Of course, during the live tweeting, they are hyperlinking back to the financial statements or the corporate website, because as I note before down here, regulation fair disclosure still applies when it comes to pushing out information through social media channels. And apart from live tweeting, studies have looked at the disclosures of earnings information, other financial news through social media channels. There are also CEO statements sometimes and videos as well. And typically in the literature, it's argued that social media provides a very nice type of channel that substitutes for low visibility, and especially firms that have very little press coverage and also likely to have lower analyst coverage as well. And so I note here Blancaspor et al. 2013. This is also discussed in Jung et al. 2018 as well, where social media disclosures, it's argued that this is less for institutional investors, but a little bit more for retail investors. And this is kind of what Blancaspor did find in, her 2013 paper with Hal White and Greg Miller. Firms that tend to have lower visibility, a higher proportion of retail investors also tend to be more likely to use social media channels. Now, one thing about this space is it's largely unregulated. There is some guidance out there from the SEC on how to appropriately disseminate information via social media. Regulation fair disclosure still applies. The general rule is if you're going to put out something via social media, it should also be broadly available to all other types of capital market participants, either on the corporate website or via SEC filings. So a lot of times when we see social media posts, there will be hyperlinks embedded in those posts. And that helps firms to be in compliance with the spirit of regulation fair disclosure. For my research, when I look at non-GAAP metrics, there's some aspects of Regulation G that does apply also to social media posts. For example, non-GAAP metrics should not be misleading, but there are gaps in Regulation G that does not apply well to social media posts. For example, Regulation G requires that the non-GAAP metric be reconciled to the GAAP metric. Now, when we look at social media posts, yes, there's a hyperlink to the corporate website or the earnings press release where this reconciliation does occur, but it's social media, especially when we look at Twitter, there are limits on the number of characters. Of course, you can put the reconciliation in an image, but a lot of times we don't see that. So, and also with Regulation G, the rules around disclosure prominence is also something that only applies to SEC filings and not necessarily to social media. So there, and I'll talk a little bit more about a study that we're working on from an experimental standpoint. There we do see some gaps or loopholes with respect to how Regulation G is applied to social media posts. So just generally in the literature, social media posts can be risky with respect to enforcement and litigation. So if you actually read, disclosures or, little white papers from law firms, from securities legal experts, they will talk about the fact that, hey, really think carefully from a firm specific standpoint, really work with your investor relations team to determine whether disseminating information via social media is right for the firm and what are the potential risks that are in place. And because there are gaps in the regulation, many securities legal experts will advise firms that these social media posts, if they're done, should be packaged with links back to the regulatory filings. Because if you are abiding by the regulation within the SEC filings and you are providing a link in your tweet or your post, it gives you some comfort that you are at least complying with, say, Regulation Fair Disclosure or Regulation G. However, again, because the disclosures tend to be two-way, and also because some of these disclosures can be reshared and retweeted, it's sometimes hard for the firms to control the dialogue that occurs on social media. So if firms do plan to operate in this space, it's generally advised that, of course, there is a strong investor relations team. There should be disclosure policies around how firms communicate on these channels. Of course, we do see cases where, certain executives do tend to go rogue a little bit on social media. Elon Musk is one person that, has gotten into some hot water. And I think this week an article came out that even though the SEC did advise, of course, they did file an enforcement action against Tesla about 2 years ago. Even though there's supposed to be policies put in place, some of these policies weren't necessarily working because there've been some tweets also coming out from Elon Musk that probably shouldn't have been on Twitter. So, of course, as I said, the dialogue is hard to control. There is a paper in JAR by Lee, Hutton, and Shu that definitely demonstrates this from a product recall perspective. And there's a paper by Jung et al. And also a paper I'll talk about that I'm working on, which is an experimental paper, which talks about the fact that these channels, gets into the space of thinking about, okay, whether dissemination can be strategic versus strategic disclosure. So we have disclosures, but firms can strategically decide which channel they actually use to present this information to capital market participants. So the Jung et al. Paper is a nice paper to read with respect to this, because they find that when we think about earnings news, firms are very strategic in whether they disclose bad earnings news versus good earnings news on social media. So they actually find that firms are less likely to disseminate bad earnings news versus social media. And this strategic form of dissemination is actually more apparent for firms with large retail investor bases and also firms that have a large social media audience. So because social media can amplify the crowd that actually sees the disclosures, firms are very strategic in whether they disclose bad news versus good news via social media. And they actually find that when firms do disclose bad news on social media, These tend to be picked up, they are reshared, and then this actually have negative consequences where there's actually then negative press outcomes, that is connected to, social media and the resharing as well. Now, one paper that I'm working on, which I'll touch on quickly, is Brown and Elliott 2009. This is an experimental paper where we wanted to really look at the extent to which firms use images in social media disclosures, more with respect to non-GAAP earnings, and whether these images actually influence how investors rely on non-GAAP earnings metrics. This study kind of plays into the space when we think about non-GAAP prominence and the fact that Regulation G leaves a gap in how firms operate on social media with respect to prominence. So from a Reg G standpoint, firms should disclose the GAAP metric with at least equal or greater prominence than the non-GAAP metric in SEC filings. However, the way how the rule is written, it only applies to financial disclosures that are either filed or furnished with the SEC. It doesn't apply to everything else. So it doesn't really apply to social media, even though legal experts will tell you technically to be in compliance with the spirit of the regulation, even if you can't disclose both numbers at the same time on social media, one workaround is to at least provide a hyperlink to the press release. So this is kind of how we set up that experiment as well. We have an experiment where we set up the prominence of the GAAP versus the non-GAAP metric in a text-based press release, and then juxtapose this with how the firm releases the non-GAAP earnings metric on social media and whether they do that with an image or not. And this study is based on things that we're actually like seeing currently in the social media space with respect to non-GAAP disclosures. So here are some graphics that we pulled for a test or a pilot analysis before we actually set up our experiment. So as you notice here, one thing we noticed that a lot of firms, when they disclose their financial metrics, they'll push out the non-GAAP number. And a lot of times we actually don't see the comparable GAAP number being tweeted out. Of course, if an investor clicks on the hyperlink, as you can see, all of these have hyperlinks back to the earnings press release. That's when they'll see the actual comparable GAAP number. Or you might find a firm, they push out the non-GAAP number, and somewhere at the bottom of the tweet in very fine print, there is the GAAP number. So we kind of set up our experiment where we have a non-GAAP metric that's being tweeted out with or without an image. The image creates a saliency factor. And then in the experiment, we have a hyperlink back to the press release. And this press release can either have the GAAP number being prominently displayed or the non-GAAP metric being prominently displayed. Of course, when the non-GAAP metric is more prominently displayed, that of course goes against Reg G, but we still set it up that way just so that we have like a 2x2. So here is a graphic from that study. We actually find that even when the press release provides the GAAP metric more prominently in compliance with Regulation G, whenever the firm decides to tweet out a non-GAAP metric that has an image, and this is the red line here, we find that investors tend to rely more on the non-GAAP earnings metric featured in the image, even when the text press release features a GAAP metric more prominently in compliance with the Regulation G rules. So the way how we're coaching these results or couching these results is the fact that how we present information from a non-GAAP perspective in social media is, in this case, totally overriding the way how the press release is set up with respect to a GAAP prominence that's in compliance with Regulation G. So we're able to document here that because of this regulatory loophole, potentially social media posts and the use of imagery in the social media posts can actually override GAAP prominence, even when the firm is in compliance with Regulation G. Now let me turn to mobile technology, and please tell me, how much more time I have left. The rest of this I can go through pretty fast.
I think George had his hand up.
Oh, yes, George.
A quick comment. If you see this as a naivety of the regulator or testing the water, it's like early stage to allow, from the stage where we were very closely regulated, and if the executives disclosure false information go to prison, to give some sort of flexibility and space to report with some sort of divergence to the social media. Is it, regulatory naivety or regulatory tolerance and purposely leaving some space to the companies to at least initially see where the direction goes until they intervene? Because we see that they want to intervene and to control, and they can do that. What do you think so far?
Yeah, great point. And this is something when I was a fellow at the SEC that I asked a lot of questions about. So one answer that I got is generally the SEC as a regulator, they still want firms to be able to tell their story. And the chief accountant at the time that I worked closely with, he viewed these types of voluntary disclosure channels. And even when you think about a SEC filing with respect to the 10K or the 10Q, when we think about the MD&A section, he thought about that section more of a free speech type of disclosures. And so he was like, one hesitancy with respect to the SEC in telling firms that, oh, you can't disclose this and you can't disclose that, and you can't do it in certain channels. The notion there is at some point you start running up against, at least in the US, some constitutionality with respect to the laws. And I was actually pretty surprised to hear that, because I didn't really think as a corporate entity, as an individual, when we think about the Constitution. And so they are walking this fine line in allowing firms to communicate as much as possible to investors, but then make sure that this is not done in a misleading way. And so sometimes instead of writing rules to kind of regulate the space, this is where they use speeches and staff interpretations a lot to try to get firms to pivot away certain things that they might see in this space. Now, with respect to social media, this is something that the Corp Fin staff were pretty open with, is that when they're reviewing a firm's financial disclosures, let's say in a filing review process, they're not just looking at the financial statement filings, they're looking at everything about the firm that is actually disclosed in that space. So they're looking at earnings conference calls, they're looking at the transcripts, they are monitoring what's happening on social media. But of course, this is where, from a regulatory standpoint, the rulemaking tends to lag what firms are doing in practice. So from a social media standpoint, yeah, there probably could be more rules in place to make sure there's less, strategery going on in this space. But there's so many other things that they have to do from a rulemaking standpoint that this is where things are lagging, but it's not like they're not paying attention to what's going on in that space. And this is where they, use speeches and statements and the one or two, enforcement actions or Wells Fargo notices that you see come out, for example, against Netflix and the issue with Tesla and Elon Musk. Again, these are little nudges to the marketplace to say, hey, this is where we need you to be a little bit mindful of. So absent just writing rules, this is how I understand that they're still monitoring the space and nudging firms along.
Thank you. Thank you. Lovely.
Okay, so with respect to
Nerissa, I had also just a quick comment, if I can.
Sure.
I mean, it's not related to the experiment, but I wonder if you've thought, I mean, you mentioned about the underlying incentives or mechanisms. So I wonder if you've given it any thought to the compensation packages that executives have in relation to the kind of disclosures they make. So there are certain companies that rely only on profit or earnings in their compensation, but others are more long-term focused. In addition to the option package, they would link their bonuses to quality, customer satisfaction, and other things. So I wonder if that could be a reason why they are more, I guess, round. They have a more rounded disclosure of the non-GAAP measures rather than just focusing on GAAP. So yeah.
Yeah, that's definitely spot on. So there are a couple of research studies that have looked at the use of non-GAAP metrics in compensation packages and how this can influence the type of non-GAAP disclosures and the type of earnings items that are actually, potentially taken out of the computation of the non-GAAP information. And these studies, sometimes when you look at the way how non-GAAP metrics are actually computed in the compensation packages, sometimes the way how firms disclose the adjusted metrics can be different from what's in the compensation package as well. So I thought about at least working in this space several years ago. Of course, the data is is very intensive with respect to hand collection. A couple colleagues here at Illinois have some data on adjusted earnings in compensation packages, and sometimes how they're different between what's in the proxy statement versus what the firm actually disclosed. And I think more needs to be done in that area. I can only point to two very concrete papers that look at the impact of non-GAAP metrics in compensation contracts and how that ties into the disclosures. So Ted Christensen has a paper, I think it's forthcoming or already published in CAR, and Asher Curtis out of Washington also has a paper. I know it was under R&R at Management Science. So of course, more needs to be done in this space. The work tends to be a little bit more intensive with respect to hand collecting the data. Another thing that we're also seeing, as you pointed out, Salma, like compensation contracts are not just focused on profit or earnings, but they're focused on a host of other types of both financial and non-financial measures, which then will incentivize managers to disclose information about these types of performance targets as well. So I recently saw a study talking about the fact that more compensation contracts are focusing on, let's say, ESG type measures, which then can influence, of course, managers' decision to disclose this information and the quality of the information that's disclosed as well.
Thank you.
No problem. I saw Sudipta had a question. Is it surprising that non-GAAP disclosures are more informative than GAAP disclosures? It's definitely not surprising. I mean, this is something that's been generally found in the literature over and over again, that non-GAAP measures are more informative than GAAP measures. Of course, whether they're more informative or not is dependent on how strategic these measures are with respect to what items are taken out, you know, the quality around the measures itself. But generally,
sorry to stop you. I think it would be good if you could kindly wrap up in another 5 minutes,
okay.
and then we can continue the discussion in the cafeteria. Yeah,
Okay.
thank
All right.
you.
Sure. So with respect to mobile technology, this is really a very interesting and new area to work in. There's definitely challenges because it's very hard to observe how investors use mobile technology and to really document how it impacts the flow of information. So generally, there's a notion that advances in communication technology can improve stock market efficiency. Of course, one major innovation that we see is mobile and wireless communication. You know, cell phones, smartphones, you know, we have many different trading apps now. And, you know, data transmission is, I have here, 73 times higher in 2018 versus 2010. Now, to actually look at the impact of mobile technology on capital markets, here are at least 4 things that have been looked at in the literature with respect to the benefits versus the costs, more so on the cost side. So one study that I have in JAR in 2015 more looks about how mobile technology increases the flow of information in local stocks. And I'll talk a little bit more about how we actually get about documenting this. I have a newer study that tries to document the distraction effects of mobile technology. And there's studies that are new, they're either forthcoming or recently published, that more uses experimental techniques to kind of grasp how investors respond to information through mobile apps and, you know, the negative effects of information being pushed through these apps, etc. Recently, of course, you're going to see more studies with respect to noise trading or the trading of retail investors using Robinhood data, which is pretty interesting. So there are studies that actually have day trading data related to Robinhood, as well as a study that I've cited here that actually uses the outages in the Robinhood app to create a setting where you can actually say, hey, the Robinhood app is down. So we actually know that, okay, retail investors are less likely to be trading in the markets at this point in time because of the outage in the app. So the JAR paper that I mentioned here, trying to document the benefits of mobile technology is difficult. One way that we do that is using state level implementations of distracted driving laws. They're seemingly exogenous, they're non-information events. The way how the paper is written up is that when these laws go into place, they limit the flow of information across market participants. And by flow of information, we're not talking about the fact that individuals are limited from trading in an app during a certain window when they're commuting, but the fact that they're limited in sharing information through mobile devices, of course, while commuting. And so generally what we find is that right around when these laws go into place, local information flow declines, and we capture that by looking at trading activity, more focus on turnover and liquidity. And we actually find that there's a drop in trading activity and turnover during these windows for local firms. And generally that is the mechanism that we kind of document. And then we show that this impact is stronger or more salient during commute times in the various states across the different time zones. And this graphic here just kind of demonstrates what we generally find. So from a turnover perspective, here you can think of this as a staggered treatment design. Whenever these laws are implemented, we generally see a drop in daily turnover, generally across the board, with respect to the different distracted driving laws that we look at. And we show that also graphically when we look at things in a regression standpoint. A new study that I'm working on tries to more disentangle the distraction versus the informational effects of mobile technology. How do we do this? We're using BlackBerry outages to try to disentangle this. This is a unique setting in the sense that, and we use an older time period when the BlackBerry phones were pretty much the key player in the marketplace. Now, the neat thing about BlackBerry outages is that whenever the system went down, it limited your use of internet access, but it still allowed you to, you still could make calls and you could still use basic text messaging. So it doesn't necessarily shut your phone off, but we argue in the paper that when the system goes down, it shuts off the more distracting parts of your smartphone device. For example, gaming apps, social media apps are difficult to use during this time window when outages occur because they relied on the BlackBerry internet system to transmit data. So pretty much we find that when these outages are in place, we find that there's an actual increase in turnover and trading activity, which actually plays into a distraction hypothesis, which we have in the paper. So when we take away the distracting aspects of your wireless connectivity, do you pay attention more to what's happening in the marketplace? And we actually find that this effect, surprisingly, is actually stronger in stocks that are held more by institutions, which lines up with newer literature showing that institutional investors do tend to be distracted quite as well. So this paper is also at JAR going through the review process. So hopefully, you know, we can get it through. There's a lot of work that we have to do. And so kind of just to wrap up, I'm pretty much out of time, but from an analytics standpoint, the literature has really moved forward in using analytics to study disclosure and presenter attributes. So readability, complexity, tone and sentiment, deception and fraud markers. There's quite a few studies in this space. Lauren at McDonald, there are several papers that they have using word dictionaries. There's new techniques. You know, we have a paper using LDA, which is topic modeling, to look at the content of disclosures, the topics, and how these these topics can be used as fraud markers. And pretty much that's what we find in that paper that we have in JAR. I'll skip to this slide. Pretty much we find that when we think about what firms are saying in their not press releases, but in their 10K filings, and pretty much run a horse race between quantitative measures that we see in the F-score fraud measure versus other textual style measures that have been used in the literature, we do find that looking at the content, like what firms are actually talking about, how they're presenting, not just how they're presenting the information, but what they're actually saying to investors, do provide incremental information to the marketplace or to us in predicting financial misreporting. So just to wrap up, there's greater emphasis on narrative and non-quantitative disclosure attributes. New media channels do play an important role in markets. The literature will continue forward where we will see more sophisticated textual analytics and machine learning techniques. We have to move away, and anything that Lauren and McDonald talks about in their, they have several review papers talking about the fact that we have to get more sophisticated and move beyond just looking at word dictionaries and leveraging more, more sophisticated machine learning types of algorithms to really tease out more of the attributes from textual or narrative disclosures. So with that, I'll thank you guys, and with whatever time we have left, I'll open it up for Q&A.
Thank you, Nerissa.
Thank you, Nerissa.
Yeah, we are running out of time. So if anyone have any question, we can take one quick question. It is an excellent presentation, Nerissa, and we are following your papers badly for our research. So I'm pretty sure that most of the PhD students would be really benefited from this talk, and they can pick up some good ideas and references. I will hand over to Salma. If any one of you have any question, feel free to write in the chat, or you can also join us in the cafeteria later on. Where
May I
you can...
suggest something, if you don't mind?
Yeah.
You know, Nerissa and Sudipta had this kindness and patience and determination to be with us so long. Let's not force it, let's take any questions that might be. Please feel free to take it. Nerissa, are you happy with a bit of more time? You gave in generously enough. So let's have the discussion moving, if you don't mind. It's like a rare opportunity to have now the best time to ask questions. So please, guys, feel free to ask questions. Don't.
So
if there's anything I missed in the chat.
No.
Salma had a double question.
Well, there was one of my questions just about tweets or posts on social media. I mean, how can you really differentiate between personal opinions of CEOs or executives, like you mentioned Tesla, and the company disclosure themselves? And I mean, now obviously Trump is gone, but back then it was we'd have had a great discussion about how he could say things and just get away with it. And then in other cases, just a minor comment by somebody in their personal Twitter feed would give a big backlash to the company. So those kind of issues.
Yeah, I mean, that's a great point. And, I think the Jung et al. Paper at least touch on this a little bit at the front end, but most of their analysis is more related to the firm accounts and not necessarily, the executive accounts. But yes, there is the issue that not only are firms running accounts that are, linked to the firm itself, but executives do have their own accounts, which they message from. I know my co-author, Richard Crowley, is looking at tweets where he can pull them from the executive accounts as well as the firm accounts. But I think that's an area that's also kind of fruitful for more research as well, and more in relation to the presenter attributes when we think of the Blankenspore framework model. The fact that the presenter attributes there will definitely more come into play when we think about like a CEO's or an executive's like personal account and what they're tweeting. And, there's always a question too, is this being filtered through their investor relations team, or are they, tweeting this on their own? But if the firm does have very strong investor relation policies and disclosure policies in place, the general hope is that we shouldn't see CEOs being rogue on social media. Of course, there are some.
Thank you, Nerissa. I think, the cool ideas, the cool thing in your papers is that you always have interesting ideas that I don't know how you come up with those connections.
A lot of it is just working with great co-authors and PhD students. For example, the distracted driving law paper was a second-year PhD paper, actually. So, for the PhD students in the audience, come up with risky ideas. And then, I know it took some convincing for me to actually say, well, is this something that we could actually try to get published? But, come up with risky ideas and then, really work hard to, convince the senior researchers that you want to, embark on the journey with you in publishing these papers.
You mind if I ask you about these risky ideas, Nerissa? It's interesting because they take you to exciting destinations, but how much you think that a new researcher should consider the intuition and the sense that a question makes, as well as the theoretical backing of it, because traditionally that's what we say to our students, look at the theoretical backing of your questions and the sense. Sometimes you find contrasting intuitions, let alone evidence. In most cases, we are all two-handed economists and accountants. We find support of this idea. On the other hand, we find support on the other idea. And the theory is somewhere in between, and the evidence there. So how much you would suggest from your experience or what you have seen around in the circles, the new researchers to go with their intuition of a brave idea or the search for theoretical guidance in starting new research projects?
Yeah, I would say even with a brave idea, and I've had a couple, brave ideas. Some of them didn't pan out, but still with the brave ideas, like you still have to take it and make sure it is still steeped in the theory. And sometimes those brave ideas will still, sometimes I find like you still end up reaching an answer that you already know from past research. So for example, like research on new media, for example, like even in social media, yeah, the setting is interesting, but you still have to think about, well, are we still finding the same incentives and consequences that are in play when we think about like traditional media? So even with a brave idea or a brand new setting, you still have to parse out like, how are you moving the literature forward from an incremental contribution standpoint? It can't just be about the setting being cool, or the idea being cool. You still have to, distill things and still kind of bring it back to basics in some ways. And even with the brave ideas that are very interesting and that does help to move the literature forward, personally, I've tended to use in my research portfolio somewhat of a mixed strategy where I can't have all brave or risky papers, right? Because then, you still have to do a lot to convince people about some of those brave ideas. And so if your entire portfolio is all about brave ideas, then sometimes you might be left holding an empty bag. So definitely work on interesting ideas, but still definitely work on ideas where there's still a lot of room in traditional forms of accounting research, where there's still a lot of unanswered questions. And so still work in that space as well.
Thank you, Nerissa. I think we should probably just wrap up, and then we have an hour of networking if anybody wants to hang around. Firstly, I would like to thank the speakers again. I mean, Bjorn is back, so we had 4 excellent speakers today, 4 excellent talks, inspiring, hopefully for the PhD students and for us too. Bjorn, thank you so much for your presentation early in the morning. Raghu Rao and Sudipta still here. Thank you for your inspiring talk, and of course, Nerissa Brown. Our final presentation. Thank you all for your contribution to the BAFA conference. And this point, I just want to announce the award winners. So Kingston University has kindly presented some prizes. I mean, it's not a lot of money, but better than nothing. And in UK terms, it's still a good amount of money. You can do a bit of shopping with that amount. So the first prize is £500 and the second prize is 300. And we had a very good selection of papers. So it was quite difficult to choose the best. And we had some that were more accounting, some finance, some banking. And the whole program was really an excellent program in our opinion. So it was very difficult for us to choose what the top paper would be and what the second award would be. So we did come to some consensus, which is what I will tell you in a minute. And I will be in contact with the authors and presenters to discuss about the award. All right, so the first award, top paper, goes to Anish. And I think Anish is here. Congratulations. So yours was picked as the best paper presented today to socially responsible firms walk to talk. And Anish, are you still here?
Yeah, I'm still here. This is good news.
Congratulations.
Thank you.
So I think it was a consensus. We all agreed that this was a really cool idea, interesting idea, and also very well developed and a lot of analysis in there. So congratulations. Thank you for your submission.
Thank you.
So yeah, I'll be in touch. The second paper award goes to David Rimas from Queen Mary. So the effect of carbon intensity and on debt fundraisings in the United Kingdom. Congratulations, David. Are you here? David?
Thank you very much.
Thank you. Again, everybody really liked your paper. The idea of obviously environmental issues is very much prominent in the literature now, but in the program also there were lots of paper about sustainability, disclosure, carbon intensity, and so forth. So congratulations, well done. And then there were other papers that were kind of shortlisted, so I do want to give them an honorable mention. So Sheehan, yours was also considered as one of the top places. So if you're here, congratulations, well done, Sheehan. Good luck for your paper. And also, well done, Sheehan. And the paper by, I think Vincenzo ended up presenting it. Lucretia was meant to present it, but Vincenzo presented it instead. So the anchoring effect in visual information, eye tracking study. So again, this is something not very common in finance and accounting literature. So it was an interesting angle. So it did also get some good reviews.
Thank you very much.
And fine. Oh, thank you. You're Vincenzo. Well done. Thank you for your submission. And finally, just as a nudge or a congratulatory note to a PhD student, rising star Jose Arias was also kind of shortlisted as a strong paper for his paper. Does cross-border cooperation in banking supervision affect foreign bank lending? Evidence from the global financial crisis. So I'm not sure if Jose
thank you very much. Thank you very much.
Thank you, Jose, for your submission. So I think that kind of wraps up our conference. Thank you everybody for being here. I know it's been a long day. Thank you for sticking around. And hopefully next year it will be in person. And we will endeavor to invite people from the US to come in person and enjoy London, but we'll need a bit more funding for that. So it was a good opportunity to have this online so we can see people that we don't usually see, but next year, hopefully it will be in person. Thank you. I will turn over to Mono and George.
Salma, if you don't mind taking out of the presentation so people can switch on the cameras, see each other, say hello, and you see if you don't mind, just a little, suggestion. I believe that that's the point that the winners missing a warm live upload, and hopefully the next conference would be live, as Raghu said. He's craving, like most of us, the active physical talks and meetings. The colleagues from the US, I hope that you would like a forthcoming invitation. It's not an impose of you, but it was really pleasure to see you online. It would be even better pleasure and more comfortable to have you here live, so as people can gather around. And so we'll come. Okay, take it. Thank you, thank you. So virtual applause to all the presenters and all the participants, and let's renew the meeting for next year with some sort of potential face-to-face. And Mono, over to you before we take
it was a virtual clap. It was a virtual clap, and feel free to join us in the cafeteria if you want to. Okay, thank you very much, all of you. Thank you.
Thank you. Thank you very much.
We do have
Thank you guys. Very well organized session. Thanks a lot.
Thank you. Thank you, Grigoris. Yeah, we have networking on I think it's a different link. So feel free to join us there with your coffee or dinner or lunch.
There you can see yourself in a circle and you can move it close to people where you want
yeah,
to talk.
So it's not Zoom, it's
another link. Put it up on the discussion in the chat, the link.
Yeah, but we have to use Chrome or Edge browser or else it won't work. Is that right?
Yeah.
Okay.
You can just click the link in the schedule and you can join there. So I think we have to stop the recording here, George.
Yeah, yes, please. Let's stop the recording.